is now that the debt ceiling has passed, the student loan payments are going to start back up again. So I reached out to Catalina and her team actually for my daughter because she's a grad student and she's getting her master's in teaching. And she's my go-to person when it comes to student loans. So I thought it'd be intriguing to have her on here today to talk about everybody out there with student loan debt. If there's billions and trillions of dollars of student loan debt, I put three children through school. We paid most of it. We did have some minor student loan debt. That's why it's kind of confusing to me. So if I get questions on this, I can assure you that you guys do, especially when it comes to real estate mortgages. So I don't, like I said on my preview, I don't care if you guys are getting a house. I really don't. Catalina is going to give you her story on why she created the company, which is so cool. And so I brought her into the channel just so you guys can get educated on student loan debt because it is really confusing. So welcome. Thanks for, we talk all the time, but thanks for joining me on YouTube. And she has her little one with her today.
Yeah,
and
I'm sorry. Anyway, here he is. But I'm Catalina, and yeah, I'm the founder of LoanSense. Excited to be here. Excited for this opportunity. Happy to answer any questions. And talk. Yeah, happy to answer any questions. You want me to tell me my founding story a bit?
Yeah, just explain why this was intriguing. And I've known you for a while, and when I heard it, I'm like, you're the bomb. So what I was saying is, how did you come about even with the concept of my LoanSense? And then you can tell us what it is.
Of course, yeah. So LoanSense came about because in 2015, I went to try to buy my first house, and I went to 3 different lenders. The first 2 just never responded to me. And the third one said, hey, pay down your student loan debt and come back later. And then I thought to myself, wait, what will this house be worth in 5 years? How much ramen will I need to eat? And will my salary increase at the equivalent rate of the value of this house? Which I looked back at the real estate market and I thought, I don't know. I can't predict it. It's like an up and down market. So I didn't at the time, I was in a job where I helped people get into college and I helped them fill out the FAFSA and get education, get loans basically. And I was like, wait, I should understand this better. Now I'm being directly impacted by this. And I started really studying in depth the repayment plans. And that's when not just the repayment plans. I knew I could get into another plan, but then I started looking up the GSE, the regulator, Freddie, Fannie, all the mortgage guidelines, and basically they had recently passed guidelines that would allow you to actually use a different repayment amount towards your debt to income. So student loans would no longer be my barrier if I enrolled in one of these plans. But my student loan servicer couldn't explain it to me. And my mortgage lenders, like the loan officers, clearly did not know about these plans if they would even call me back, right? Because I was just kind of like one of these well, she's not probably going to buy right now. Let's focus on people that are going to buy right now. So basically, I changed my plan and went back to that loan officer that sat down with me, and I was able to close on my first mortgage literally within 45 days or so. It wasn't the initial house I looked at, but the point is I then thought, wait, how many other people in my generation have this same issue? And that's when the National Association of Realtors came out with all these studies and data starting in 2017 about how student loans is really plaguing our generation. It's delaying buying by 5 years on average. There's 17 million of us out there who are renting in the prime purchase demographic. And that's when I was like, wait, we're not getting this information out there. So that's really the founding of LoanSense, and I'm super passionate about it. And I ended up getting nominated for Bill and Melinda Gates Fellowship, and I went to Capitol Hill, and I really worked a lot on higher education finance policy. And that's when I really started to understand why student loan debt is ballooning. It's 1.7 trillion, and it's because colleges they don't have an incentive to lower students' debt because they want their enrollment numbers to be high. So if they scare you from taking debt and you can't, and your parents don't have the funds or didn't save, and you're scared away, then they're going to have poor enrollment. So they don't really want to educate you on what's going to happen. They don't really want you to understand what salary you actually have to earn in order to sustainably pay back your loans. They don't want that really. And so that was when I was like, they really didn't understand it. And financial aid officers couldn't really explain any of the student loan program. So I'm like, so who is really the master and the person to dominate this space to actually help student loan borrowers understand their options? It's not financial aid. The servicers can barely staff their call centers. It's not mortgage lenders. It's like, it's not really financial advisors. They majority focus on like refinance options, right? Which is most appropriate to people who can earn enough to really pay off their loans. And so it's like nobody really is like an expert in dominating this space in a way that could be super helpful to student loan borrowers. So I knew there was a niche in the market to help borrowers, but I also knew there was a niche in the market to also help lenders understand what the options are to improve their loan production, but also to help borrowers really understand their options. Because the idea is that, you know, like who else is going to advise people at the most pivotal decisions they're making in their lives? And buying a home is really one of them in our supposed to, right? In our late 20s, early 30s. And so I really wanted to make sure people got that information.
And that's why I had you on here, because I don't know if people watch me every day talk about economics, I get it. I get numbers. I love numbers. I love statistics, all this other stuff. Where I get completely confused, and you kind of reiterated it, is insurance and student loan debt. You don't know. I can almost guarantee if you look at your homeowner's insurance, car insurance, your health insurance, your life insurance, and all that other stuff, you probably don't have a clue. I don't. I got life insurance of whatever. I've had it for 20 years. I don't even know anything about it. Is it, how long does it go for? How long is this? So there's so much confusion when it comes to these areas. That's why I'm like, let's have Catalina on here, because this is her life. You eat this, you breathe this, you live this. And that's why I love it so much, that you know more about student loan debt than I ever known, and anybody that I know. So I reached out to you. Well, we've been working together for a while now. But over the pandemic, a lot of, because of COVID and everything, people were in forbearance on their homes, and then they also were in forbearance, or I forget what they called it, for student loan debt. For
Yep.
they didn't
administrative forbearance. Yeah, it's the same thing. Yeah.
So for 3 years. So
Over
during
3
the
years.
process, what happens a lot of times when we're talking to borrowers, because they don't have any payments, or they haven't had any payments for so long, they kind of forget about it. And then you pull their credit, and it's like, oh my God, you got $90,000 in student loan debt. What do we do? So let me just explain to you, and Catalina will back this up. When you're trying to get a mortgage, and I did say, if you're not, please watch this video, even if you're not getting a mortgage or trying to get a home. But if you're trying to buy a home, what happens is, over the last 3 years, since there's no payments due, your student loan comes up, but there's no payment. So when you're trying to qualify for a mortgage, in most cases, you either need to count 1% of your balances, or if
Which
you're
is
going
$900 in your example, just to make it clear.
So,
right.
And in some cases, like if you're going with a government loan, you can go with a 0.5%.
Right.
But that's
so
really a huge chunk of change. The first time I talked with you and you helped me with this borrower was a young lady who just got her doctorate. She was making 75 grand. She had over 300,000 in student loan debt. And she was a mother and a wife and had 3 kids. And you got her payments. When we were trying to equate her out to get a home, we had to use a $3,500 payment on her student loan debt because she owed 350,000. Never qualified, because she makes 75 grand, and her husband made some money, but not enough to suffice. So I reached out to Catalina, and she's like, oh, we get her payment down to like $200. I'm like, how? And she went through her whole system, and I was like, you got to be kidding me. And so what a lot of people think is when you go through these payment plans, I didn't even realize how many there were. That's first off. But a lot of people think, okay, you're refinancing my loan, and you're putting me on another long-term thing. So yeah, I'm going to save some money initially, but I'm going to kick the can like the government's been doing, and they're going to accumulate all this debt, and you're just going to keep paying on it and paying on it and paying on it. But then after you educated me on all this, it's like, no, most of programs are a 10-year pay plan. And if you don't pay them back, you don't have to pay them back. So can you explain, if you could, just educate us on the different programs? I didn't even know there were, because I kept sitting on the sideline thinking, okay, is the government going to do, give the forgiveness? Are they going to give 20 grand? Are they going to do this? What are they going to do? And everything keeps getting shot down. So now everybody's now looking back into it saying, okay, what are my payments going to be? So that's why I asked you on here. So could you go over the multiple different payment options or plans out there? And then also, when somebody does this and they go into a program and they use your system and they save, half of what they would have been paying each month, they save that. Are they going to have to extend that for now 30, 40, 50 years on a student loan? So those are the questions I have, and I'm sure many people out there have the same question.
Yeah. Okay. So first and foremost, the reason why so many Americans can reduce their payment is when you come out of school, the government automatically puts you on what's called a 6-month grace period. So from the time you graduate, you have 6 months. In that 6 months time, the servicer is like, basically a couple months before you start repayment, they'll tell you, okay, based on the principal and the amount of interest you have, your payment is going to be whatever. It depends on how much, like, let's say you took out 50,000. They'll say it's going to be $500 a month, right? This is an example. And $500 a month in a 10-year plan over 120 payments pays off all the principal plus the interest over 120 payments, 10 years, right? So that's a standard plan. But what is happening now is more and more people are graduating with more debt in their balance total than they're making in their first year out of school. And so what is happening is that first payment for a lot of people is just unaffordable. Or let's just say the initial 1 to 2 years, it's affordable because you're graduating, you don't have as many financial obligations. It's not like you have children, a family. For a lot of people, they don't. And so it's manageable at that point in time. So then what ends up happening is people stay on that and then they're like, oh my God, I'm struggling to make my student loan payments. And they don't really know the options. They'll call the servicer, and Navient just got in a huge lawsuit because what the servicers would do is they would just say, okay, we're going to put your loans in forbearance. So you're just not going to pay it for a year. That's not a payment plan. Forbearance is not a payment plan. Forbearance is not making a payment, right? Which is really, really harmful because it's just like that's kicking the can down because it's still accumulating interest. You're just making no payments on it. So the government had multiple options. Like I'm going to talk through a couple, then I'm going to go into why we tell people to get into income-driven plans, because the government will say, okay, go on forbearance, which is a horrible idea. It's not a good plan. It leads people into default. That's what it does for the most part. And that's why these servicers are getting sued like Navient. And now they're not even a servicer for the government anymore because they've performed so horribly. Then people will say, okay, well, then you can get into an extended repayment plan, which is basically saying instead of 10 years of repayment, you can go into 20 years of repayment, which is literally saying instead of 500, now it's going to be about 300, except you have to pay for 20 years. So you're paying back more interest, right? Or they'll do something like, hey, pay over 10 years, but you'll start these 2 years lower, and every 2 years it's going to go up. So by the time you're at year 6, you cannot afford it anymore. And then you're scrambling to think, what do I do next? Is I can't afford this. So you end up going into some kind of extended plan that ends up extending it for 20 more years, right? So the idea is we say, okay, let's get rid of all these options because they have horrible outcomes. They do not have good outcomes. Let's put people into the plan that has the best outcomes, and the best outcomes based on the CFPB, the Consumer Financial Protection Bureau's study of over 100,000 borrowers, that getting into a plan based on your income is the best. Because if you have no income, because let's say you got laid off during the pandemic, well, the pandemic doesn't count because we're in pause, but let's say you get laid off in the future, you can tell the servicer via filing paperwork, that's where we help consumers, that you have zero income right now. The servicer will actually make your payment zero. And that actually counts as a payment. So you're not getting eliminated from making a payment like going into forbearance, or you're not put on something that you have no idea if you can afford in the future. So let's say you're making $0 right now, you get a $0 payment for a year. Let's say your income goes up. Okay, your payment goes up slightly. But for most plans, your payment does not exceed what that initial 10-year fully amortized payment is. So you're always protected from too big of a payment, but you have the ability to get your payment down to zero if you don't have a job. And so now to answer your question, so that we recommend that because that protects people the most based on that their situation that day, right?
Yeah.
And to now answer your question of like, does it extend? It's completely based on your employer. So if your employer is nonprofit, government, or nonprofit or government 501c3, there's some other 501s that come under the classification, then your payment will never get extended. If you are a private sector employee, your payment term may be extended if you don't pay off the balance plus interest before the 20 years. So it may get extended. But again, every time you're between jobs, you can file and get a $0 payment that counts as a payment, right? So it still protects you because the only other option is to go into extended repayment, which is 20 years anyways, and doesn't protect you from having from not being able to afford that payment. They'll just put you in another plan and then it just goes 10 or 20 more years, right? That's why you hear people paying on their student loans until they're 65 because they keep on changing plans and it keeps on extending it. Whereas income driven does not extend it. Like if you paid 5 years in standard, that all counts. If you paid 5 years in extended repayment, that all counts. It doesn't penalize you the way the other plans penalize you. Does that make sense?
Yep,
I mean,
absolutely.
the government could have not made it any more complicated, right?
I know. I think reality is going to start hitting here very soon because so many people haven't had to make a payment in years. Especially think of you, well, rents are going up, everything's going up, house prices are going up, car loans are going, everything's going up. And now you're going to be slammed with this 3, 4, what's the average household or the average person's student loan payment or debt?
Okay, so the average American's payment is about $350.
Okay.
That's the average undergrad. Average undergrad payment is $350.
So if you've been in forbearance or you haven't had to make payments in 3 years and now all of a sudden the debt ceiling passes and they're saying, okay, now you got to start making student loan payments. Now you got an extra car payment that you got to make each month. Think about that. I mean, $350. That's a car payment in most cases. So now, I mean, and that's probably on the low end. You have people with
that's
doctorates and all this.
Undergrad. That's not grad school. Yes.
I saw something the other day. I think the average doctorate degree or something like that is like between 2,500 and $3,000 on the minimum side of things. So I think a lot of people are going to get shocked here soon when they start getting their statements saying, whoa, why is it so high? Why do I, and then they're going to start seeing, oh man, now what do I do? It's like Christmas. You go out there and you're in the holiday mood and you're spending and buying everybody stuff. And then January, February comes and you get the credit card bill and you're like, oh shit, how am I going to do this?
Yeah.
You know what I mean?
No, it's serious.
So that's why I asked John here because the reality is going to hit soon. And
right.
I was like, I just want everybody to be educated on all of this stuff. So I don't know if we have it. Do we have any questions that popped up yet?
Yeah. We do. We have quite a few. Do you want me to just read? There's some comments and some questions in there. Do you want me to just read them?
Actually, Kat can pop them up. If you wouldn't mind reading them, and then because I can see them, but I'm old. Hey, just so you know, my birthday's tomorrow. I'll be 58 years old.
Happy birthday.
Well, Happy birthday. So that's why I can't, I'm old. I can't see the small print down there. I just wanted to admit
You're not old. Okay. 58, that's spring chicken. Okay, when I finished all of my college education, undergrad plus some grad school, I consolidated my federal direct and requested an income dependent plan. Okay, income driven, but dependent. Okay. But they only gave me, let me read the remainder of the comment. They only gave me the graduated option with increasing payment every 2 years. However, my income stagnated. I work overseas though, so I don't think I qualify for a lot of the plans. Okay. So I think I don't know if there's a direct, what are my options? Okay. So this is a great scenario, right?
Perfect.
So this is the problem with the servicers and why, this is the problem with the servicers. When you call them, they don't have your information in front of them. And for a lot of borrowers, because they work for government or nonprofit, if they tell you to go into public service loan forgiveness, you get transferred to another servicer so they don't make money off of you anymore. Okay. So it's actually, they have a disincentive to give you the right information. If they tell you, Danielle, who asked the question, because of your employer, you're going to get transferred to another servicer and we're no longer going to make money, they're going to tell you the option that will keep you with them and them making money. And the option they're telling you is to make them money, which is just get on a different plan that is not, may not be the best for you, which in this case, it's definitely not the best because it's a plan we don't even recommend in our software because it's so harmful to borrowers, which is your payment increases every 2 years. So what they do is they say, go into forbearance or get into this plan where your payment's super low now and worry about it in 2 to 4 years. But what they don't tell you is a lot of interest is accumulating because you're not even making your payment to even cover the interest and you don't qualify for forgiveness. So you're just really kicking the can down the road. And they don't tell you that in 4 years to 6 years, based on the data, you're not going to be able to afford it. So they don't tell you the full information. And I would we highly advise people against graduated plans in all instances because outcomes are so bad.
It kind of reminds me of like the subprime lending. You know, you bought this house you didn't really qualify for, and then the payment was so low. It's like, well, heck, I can buy $1 million house and my payment's $2,000. Sweet. Well, the numbers don't add up, and then over 3, 4, 5 years, then it's boom. That's exactly what happened with subprime mortgages. Exactly.
Right.
So okay, that was my comment.
To answer Danielle's question, like, what are your options? Well, I don't want to self-promote, but I have to because we give everybody a free analysis. So if you go to myloansense.com, we give everybody a completely free analysis on what their best option is. Options, there's multiple options, but we highlight a core recommended option. Within income dependent, Daniela called them income dependent. They're called income driven plans. There are 5 different plans. Okay. And all the plans differ slightly based on when you originated your loans, the type of loans. But the point is we will highlight the best option for you. And we highly recommend those plans over the graduated repayment or the extended repayment option. So that's what I'd recommend, Danielle, is to go onto our software and get the best income driven plan. And we can even help you file that paperwork. I think on the description of this live, we even have a discount code if you want to move forward. But the point is like, we will advise you based on your scenario, what the best plan is. And we will also give you the best pro tips to long-term manage your student loan plans and be with you over the repayment journey, right? So I would say go get a completely free analysis and understand what your options are with the income-driven plan. And do not, my one piece of advice, do not enroll in graduated plans because there is no interest subsidy or relief if you can't make that payment. It just puts you in a worse off position in 6 to potentially 8 years, and it does not qualify you for forgiveness. And that's the part that kills me the most, is that it doesn't qualify you for forgiveness, you know? Yeah.
The more
I think we have another question, by the way.
Okay,
but
yeah,
please
go ahead. No, go ahead. That's why you're here. I can talk to
well,
you.
I'll let Kat. Do you mind putting up the question? But you make a comment, Dan. Sorry, I didn't mean to. I'm just letting you know because you asked me to track the questions. You know.
Oh, no worries. I can talk to you anytime. I just want people's questions to be answered because this is big.
Can I make extra payment towards my student loans while in school or during the grace period to reduce the overall interest accrued and lower the total loan amount? Okay, so Nancy, I love this question. And I love this question because in order to answer this question, we need to everybody needs to understand their strategy. Is their strategy to pay as quickly as possible, or is your strategy to understand is there forgiveness options and to maximize the amount of forgiveness you're going to get, right? So in order to answer that question, my first question always is like, what is a person's income? Can they afford to accelerate payment, like pay as much as possible over the next 5 years? Could they actually afford it? Or are they struggling to make that monthly payment and there's no way they can do it? They can't set a goal where they can actually live in a budget that doesn't basically overextend them to make maximum payments. So it really depends on your scenario. So Nancy, if there's no opportunity for forgiveness and you're going to have, or you may have a really hard time making that full payment, it totally depends on your scenario. But let's say, for example, let's say in the scenario you go in our software and we show you you're going to get $30,000 of loan forgiveness. I'm just making up this scenario, right? And we can tell you how to optimize to get that forgiveness. Then there's no point in you accelerating that payoff. But let's say you're like, I got this great degree. I'm going to make over 6 figures. I can slam out this debt in 5 to 7 years, no problem. Then this strategy you're talking about is really great, paying off your interest, because at the end of the grace period, it capitalizes. And what capitalizes means is they add all that interest you didn't pay, they put it on top of the principal. So now you have to pay interest on the principal plus the interest. So every day you're accumulating interest is now based on both these items instead of just one of these items. So if you're going to go on the strategy and the route of pay off as quickly as possible, then you want to pay off that interest before capitalization occurs at the end of the 6-month period. So all the interest while you were in school and in that 6 months, if you pay it off, then you're going to have a lower principal balance that will accumulate interest, a lower interest over time. So that's absolutely the best thing to do if you know you want to accelerate payoff. If you know you're going to get loan forgiveness because you're going to struggle to make the payment because you have too much debt, then that's unnecessary because you're just lowering the amount of forgiveness, right? So it's completely dependent on the scenario. Again, Nancy, I invite you to come into our software and get a completely free analysis to see, is there projected forgiveness, right? And then you have to ask yourself, once repayment starts, can you afford the payment, right? Because if you, and also being realistic with yourself. There's some people that are like, well, I'm just going to cut my spending by $500 and that $500 represents 30% of their budget. And I'm just like, wait, what is your budget? How are you just going to cut $500? Like, is that possible? You know what I mean? Like, so like what can you afford and is it realistic? Because if it's unrealistic, unattainable, and extremely challenging, then it's not going to be sustainable and you're not going to be able to do it over the next 3 to 5 years, you know? So that's why that's an absolutely good strategy, Nancy, if you're going towards accelerated payoff. And if you could do that, we recommend it, but in a lot of people's scenarios, they can't, you know? And so completely, Nancy, dependent on your scenario, again, it doesn't hurt to get that analysis, you know?
The analysis should be, if it's not down there, if you could put it down there in the description, there should be a link down there for the website. So I use it probably every day. We talked to, I think in the last 2 days, we've gotten about 30 applications. I can guarantee half of those people have student loan debt. So then I use the calculator, go in, and many times I run the numbers prior to, and then I give the people, if you want to check out this service, you could save probably $300-400 a month. And a lot of people are doing it because the thing is, you can use Catalina's website just as a tool, just to say, it'll give you one proposal saying, here's what you should be able to cut your payments based on just your income alone. There's other programs out there that she can qualify you with. So all that's free. What they do is you guys don't charge hardly anything for your services, which is amazing as it is. But if they were to help you, they help you figure out which plan is best for you. Then they handle all the paperwork. And it's not only that, they'll help you keep up with it. Because, like, for example, I have a few different companies. I had one of my companies, we forgot to file our paperwork with the state for the last 2 years. So now I got a bunch of penalties and everything else because I thought my attorney was doing it. My attorney thought my accountant was doing it. So it goes on. Their services, they'll handle all this for you. So I'm not, I'm promoting her services, but I think it's a hidden gem that people need to know about.
Yeah, absolutely. And at the minimum, like we are all about getting people education. So getting the free analysis and determining like which options are best for you and just understanding that even if you don't like end up using our service, right? It's just great to have. And of course, like we release, once you sign up, we are constantly updating bars that come in with all the latest federal student loan program updates, right? So we just kind of help you keep on top of it. And then once you do sign up though, if we also offer like insight into profession and state dependent forgiveness too. And so that's not in the initial software outputs, but that's also valuable, especially since there are some niche programs out there, you know. But
Yeah.
um, yeah,
Cool.
absolutely.
Is there more questions down there?
I don't know, Kat, do we have more questions?
Kat, if you can pop one up. If not, when we talk about Kat, she's our moderator in the background. Hey, thank you for the happy birthday. So here, let me give you my daughter's scenario. Just so, and I know I
Sure.
talked to Gene about this. So here's my daughter's scenario. This might be somebody out there. She graduated with a teaching degree. So she then took a teacher's aide position so she can continue and get her master's. So
Right, she
she's
needs
still
those
living.
teaching hours, right?
Yep.
Yeah.
So she's still living in a home. So
Mhm.
she can afford it because she has really no other bills. But if she didn't live here, there would be no way she can afford this. So my question would be, is because she's a teacher and she's going into that profession, she's trying to get her master's, she's paying as she goes. Is that it was kind of like the same question that you just answered? Would it be beneficial for her to continue to keep, spending every penny she has paying down her student loan debt while she's still living at home? Or, even like during the summer, she's not making any money, because she's a teacher's, she works as a teacher, so she's off for the summer, so she has no money coming in. So this would be a time where she could kind of not have to make payments. And then eventually she'll be working at a school, which is a government entity, so she'll probably get discounts on that.
Right,
So
right.
is it beneficial? Would it possibly, and I'm not, we're not
Right,
etching this
sure,
in stone.
sure.
I keep telling her, saying, well, just go with the system, go with Catalina's system, send in your income. You're not making any money right now, so those payments will be basically waived because you have no income. And then as you go through, even then when she's working, she's not making that much money because she's a teacher's aide during this master's piece.
Right.
So
So there's a
that
few
one,
things. So really
yeah,
quick, there's a few things. With teachers, they get access to the Teach Grant.
okay,
So the Teach Grant, after 5 years, they get something like $17,500 of their debt forgiven. There's the Teach Grant. There's also different states also have different loan forgiveness incentives. So, I mean, basically, if somebody comes in and they tell us when they book after they purchase, they book an appointment, they tell us their scenario, like, hey, I'm going to be a teacher. I want to know, like, what should I do for grad school? Some people like to plan, what do I do with undergrad debt before I go to grad school? Should I take out more? Should I try to take out, like, they ask these questions, right? But then we can also, when bars ask these questions ahead of scheduling time to speak with an advisor, they will look up profession and state specific. So we'll look up state specific and profession specific programs ahead of meeting with a borrower. So let's say, like, if we know, okay, someone's in law enforcement, like, they'll say, I'm doing this, or we'll ask. That is outside of our software outputs. That's information that we could provide. So with her scenario, like, I would try to understand what's left over after the Teach Grant. And then like most teachers, just like a lot of healthcare workers work for nonprofit hospitals, then the remainder can qualify under public service loan forgiveness, which means that her loan term won't be extended. So she'll make minimum payments. And when I say minimum payments, I mean literally every 2 years you refile, it's based on the lower of your income. It's based, if last year's income's lower, or like right now your income's lower, you can use the lower of the incomes. If you're between jobs, you can use the $0 income. You know what I mean? And so over time, you're actually paying less. You're maximizing your forgiveness by paying the lesser of the
got it.
most recent year versus this year. And then that qualifies you. And the most important thing, in fact, I could probably find a link for Kat to share out, um, where the most important thing that we always ask people, especially if they're trying to qualify for forgiveness, and it's what we do pretty automatically for bars coming through our system, is we file what's called a payment count letter. Okay. So this payment count letter, what it does is it basically demands the servicer, I shouldn't say demand, but demand, more like a legal term. It asks the servicer to provide me an accurate and updated payment count. Because there's a lot of people, they're like, oh, I went 3 years in forbearance. I paid for this amount of months. I don't really remember. I was between these jobs. Like they don't really remember how many payments they've made, right? And there's not, except there's some website updates right now with some servicers that will give you that. A lot of the servicers don't. So we have what's called a payment, like it's crazy, right? In the mortgage world, you know exactly what payment number you're on. It comes on the statement. In the student loan world, people and the servicers are not
And if
reporting.
I'm wrong, I'm liable. It's like with you
I,
guys
right,
are like,
right. In this,
I mean, student loans are like the Wild West. It's like
right,
just
right.
defraud these people, tell them whatever they want to hear, and just keep making money. It's a
Right.
shame.
So right now, I know right now, Biden passed and updated, and I'll send a link, Kat, right after I'm done speaking. And that's to request our payment count letter. And literally, you do is it's a form. You enter your email, you enter some information, and then we give you the link to our payment count letter, and then you can even submit that yourself, right? But the point is like the servicers messed up people's payment count so badly that Biden passed what's called the income driven waiver program, which means that if you enroll into one of these income driven plans before the end of 2023, it forces your servicer to count your payments because they haven't been counting them. Plus, they're forced to count an additional 3 years, not just the 3 years we haven't been paying, all that counts towards loan forgiveness. So, literally, 3 years of non payment counts towards loan forgiveness. They're also forced to count an additional 3 years of time you did not pay towards loan forgiveness. So, let's say people have been paying for the last 14 years, even though they're supposed to pay for 10, nobody's been counting. So they're like, oh, I've been paying for the last, like people come and they'll be like, I've been paying since like 2009. I'm like, okay, but you've been working for the government and nonprofits for 2009. So you shouldn't be paying anymore. Like, I don't even understand why we're having this discussion right now, right? You should be done, right? But they're not done because nobody has been tracking how many payments they've made. And I'm like, this needs to stop. We need to demand the servicer right now count your payments, including the 3 years you haven't been paying through administrative forbearance, and also 3 additional years of either consecutive non-payment or 3 additional years of non-consecutive non-payment. But the point is there are rules on what they need to do to count even they're supposed to count extra payments. And this will now allow people, and this is what we've done for so many people, is we have now gotten them $0 balances that they thought they had like 50 grand more to pay because no one's tracking and holding these servicers accountable. And so you could literally come through our system thinking, oh, well, you're going to start your payment at whatever because that's what it was before the pandemic. And it might be possible if you've been paying for a while that you don't even have to pay anymore. And so
How does this happen? How does I mean, you're talking trillions of dollars, and it's just like, well, no wonder it's like I hate the college system anyways and how it's all set up, because it's like they just pump this with you have to go to college, you have to go to college, you have to go to college, and now it seems like it's not even really regulated. You just mentioned in just this time that we sat down, one servicer, well, the person who actually commented, one servicer basically just lied to the person because they said, you only qualify for the graduated system, which they probably qualify for more, but you were saying they stay there because they make money that way. And then you're saying, you get during the pandemic, that should have counted toward your 10 years. They're not counting it. Here's what happens a lot of times that we get. I'll pull credit on somebody and they'll have their student loans deferred, and they'll show them currently is like 90 days behind. And it's like, well, how did they, and let me clarify that though. It does the credit report when I pull it, it should show me all your lates. So how it should work is you pay within the month, so you're okay, or you're 30 days late, or you're 60 days late, or you're 90 days late. You have to go 30 days late to go 60 days late, and you have to go 60 days late to go 90 day late. I've had multiple credit reports where I pull it and every student loan is like 90 days late. No 30s, no 60s. And it's like, it can't be. You have to go 30. You see what I'm saying? You have to go 30 days late.
What ends up happening, that I've spoken to some of the credit bureaus directly about this, is the servicers don't report on time. So they'll wait after 60 days to report the late payment so that by the time it gets reported, the person's already 90 days late. And it's the servicer is not reporting to the credit bureaus on time. And so now the consumer pulls their credit and it's like 30, 60, 90, even though like they might have thought, well, I set up auto debit, but something happened to their bank account. They weren't aware and they just didn't see any of the notices. And sometimes it's genuinely an error. They didn't mean to just not pay, right? That's why we should take Ron's question, but this is my number one advice when we enter repayment. Understand your options. Number one, get into an income-driven repayment plan if you cannot afford your payment, okay? Please do that. We will help you understand what proof of income you should be submitting, and we will e-file it for you to get the best payment amount that you can afford based on your income documentation, okay? That's second. Lastly, sign up for auto debit. You do not want the deadline to go by and be like, oh my God, I forgot, And so as soon as you get the notice from your servicer, sign up for auto debit because number one, it will save you from getting dings on your credit, that 90-day late stuff that happens all the time. Additionally, what it will do, it will lower the interest rate by 1/4 of a point on any of the accumulating compounding interest. So enroll in auto debit. Those are the 3 things to do. Like understand payment, understand if you can make it, get into a plan, and sign up for auto debit. And people are like, well, I had auto debit before, so it's just going to go auto debit. It's like, no, they canceled all the auto debits. Nobody has auto debit. So if you once upon a time had auto debit, please sign up for auto debit again. It does not exist. So should we take Ron's question,
Yeah,
Dan?
absolutely. Absolutely.
How often do you have to reapply or re-update the paperwork with the feds? That's a great question. So the paperwork is due annually. And what's complicated about the paperwork that's due annually is it's not like the tax deadline where it's published and everybody knows April 15th or around that is the tax deadline. Your deadline is unique to you, which is so complicated because then no one knows when their deadline is, right? So let's say you submit your paperwork like July 1. Your deadline is going to be around July 1, but it's when the servicer processes it. So that's very complicated because people don't know when they submit and they're like, don't find the documentation. So it's very complicated. So we at LoanSense will help people track when their deadlines are. That's another thing we do. But then if you're between jobs and don't have any income, at that point in time, you should also file because that makes you eligible for a $0 payment. So once again, if you file off of your normal filing track, then you're going to have a new deadline at a different month and day, right? The following year. So the deadline never stays the same exactly. And it's completely unique and dependent on the person. And so that's another nightmare that it produces because then nobody remembers. If I did something a year ago, who remembers exactly what they did day they did it a year ago? Nobody remembers. And so that creates a nightmare because then what happens if you are late in refiling, then all that interest that's supposed to go towards forgiveness, if you do not file on time, this is why it's important to file on time. And I think Biden's working really hard with the new plan to eliminate this rule, is that the interest you didn't pay now gets added to the principal. And then the compound interest goes on both, which is crazy because that shouldn't be happening, right? So Biden is working really hard to change that, but it's still, despite its issues, is still the best type of program out there because the other ones have way worse outcomes. And so you can either save yourself from paying it off as soon as possible, or if you have to manage it, you can get the help of someone like us and we'll save you a lot of headache and a lot of, especially if you have like 10 to 20 different loans or you have a high balance, that's when getting help is really important. If you have something like 10 grand, not that much, and you're going to pay it off soon, like maybe it's not worth it. But if you have a high balance or multiple different loans, like 20 different ones, getting help is key because you do not want to mess it up, And so I hope that answered Ron's question.
And you mentioned to me one time, do not refinance your student loan debt. Correct?
So let's talk about that. So refinancing is a strategy that works for the people that can afford. We say if you can afford to make your payments in 5 years or under, and you have systematically shown over the last 1 to 8 year to 12 to 18 months that you can consistently pay more than your minimum payment, like 150% or to 200 or 250%, and that your budget can allot for that, and you're confident that you can pay it off over the next 5 years, then you're a great candidate for refinance. But the problem with refinance is private companies accept so few applicants because they care about your debt to income, they care about your income, they care about your credit score, and they also care in a lot of instances if you have a cosigner. So if you have a parent willing to co-sign your debt, if you have all those, your prime credit score bar, you have enough income, you blah, 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 check the list, then you can qualify for refinance. And most people, like recent graduates, do not check those boxes. It's like if you come out with an MBA or prestigious law degree, you might check those boxes. But if you don't check those boxes, it can be very hard to refinance. So the reason we don't go out with the message of like everyone should try to qualify for refinance is because it's demoralizing, because only a quarter of Americans qualify, and even fewer Americans, like for example, like companies like SoFi take under 5% of applicants. So we don't want to drum the beat, oh, refinance, 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 because unlike mortgage, if you qualify for mortgage the first time and you don't royally mess up your credit and go take out 3 car loans or something, you should be able to refinance, right?
Yeah.
That's not the same for the student loan world. The government is taking all the risk in lending to you as a student. Now that you've graduated, if you want to go to privatize your debt, now you're being analyzed for your credit risk that you weren't analyzed when the government gave you the loan in the first place. So the ability to refinance is very low for a lot of people. And so that's why we always say it's not the first option people should recommend, because it's a very specific type of bar that should refinance. And that's not the majority or the average American, if that makes sense.
How many you listen? I listen to this and I'm thinking, how many people are paying millions and millions of dollars more than they even have to? Because
Well, during the pandemic, we got a lot of people 6 figures of refunds and repayment. I mean, in overpayments, they literally got checks from the US Treasury in overpayments, or like people, like anybody that, for example, I know Danielle mentioned, you made payments during this pause. If you decide 3 days before we enter repayment that you didn't want to make those payments, you can get that money refunded. So what ended up happening, Dan, is there was several healthcare professionals that were like, oh, payment pause. I'm going to go nuts. I'm going to put all my savings into my student loans because I'm going to accelerate my payoff, which on the surface level isn't a horrible idea if they can afford it, right?
Sure.
But then what ended up happening is the mortgage market moved to the 2.5% interest rate. And they're like, wait, I don't even have a down payment. I'm paying $2,000 in rent. I could buy this house next, like 3 blocks down. And I just spent all my down payment money on my student loans. Like, what do I do? I'm like, we can get that back, and you can now have a down payment. You know what I mean? And
Yeah.
so we got several people, like, they were like, I cannot believe this. They took pictures of their US Treasury checks and sent it to me. They're like, I cannot believe this is a thing.
God, I can't believe how this is harder than mortgages. It really is. I mean, mortgages, it's like, okay,
so much more. Yeah, there's a lot.
programs,
yeah. I mean,
and you have
are hard too, but mortgages are hard too. There's a lot of rules for underwriting.
yeah, but not like this. I mean, you have a moving pendulum everywhere you go. You know, how long do I have to pay? Well, that depends. You know, are they going to post my payments on time? Well, that depends. You know, it's like, oh my goodness.
Are they going to post it to my credit? Are they going to post it to my credit on time? Probably not. Are they going to help you track your payments? Probably not. Are they going to help you understand how to file your paperwork and get in the right plan? Absolutely not. It's like crazy, right?
Well, the good news, all this only costs you $299 a month for 7 years. No, it doesn't. Here, there was a post that just came up. How much, you know, I'm expecting I'm going to pay $700-800 for your help. Somebody just posted a question. Do they have to pay a fee now? Do they have to pay a fee every year? How does the fee structure go?
Yeah. Okay. So we, after you get that free analysis and you want to move forward and use our help, like I said, really people with lots of loans, high balances, things like that, or they're getting married. We have a marriage tax calculator. Getting married has a lot of implications on your repayment. And you want to move forward, then it's either 249 or 3 payments of 89. Kat just shared a discount code, LS20 off. By the way, that is good for till the end of this month. So I would at least, even if you don't buy at the end of this month, get started, because if you get started with your profile before the end of the month, you will get access to this discount code. And then if you want to, every single year you get help. We do not charge 249. You pay less to come back. And that less amount, if you need filing only versus if you want to speak to somebody again, and get on another session, the prices vary the second and third time around slightly. But right now, filing goes for 89 and filing alone after the first session. So it's literally like a TurboTax model after we meet with you the first time, after we get everything set up. And it's truly just filing alone. It's around 89. It depends on like when you do it, because if you commit early, it's a different, like we all give discount codes, right? And then if you want to have another session and file, like let's say some people get married, have children, their situation changes significantly, right? They might have just closed on a house and they want to come back, then we charge 197. So we discount it from the initial. But we have people that have come back to us 2 or 3 times, like over the pandemic, and they're not even making payments, right? So
well,
like
don't forget, if you guys do it, if you use the code down below, it's $200. $200 to save you potentially thousands and thousands and thousands.
Yeah, so the code below will make your price 229, but you are right. We will tell you how many dollars you will basically get back for every dollar you spend with us, and it's a lot of money because the average person reduces their payment by about $600. Obviously, the people that move forward have a higher amount of debt, right? They'll save about $600 on average, and we qualify people for over $80,000 of forgiveness. So, I mean, if you think about it, we're literally charging pennies relative to the value. And so
it's a huge service. I mean, it's huge. There's nothing else out. I've been doing this a long time. And when I was introduced to you, I was flabbergasted. I'm like, how did nobody think of this before? I mean, this is genius, because you're fitting a niche that most people, almost everybody has student loan debt nowadays. And they just sign the dotted line, and then they go to school and do their thing and graduate, whatever. And then they just start making those payments. Nobody really analyzes. It's kind of like I said, life insurance or just your car insurance. When's the last time you looked at your car insurance to make sure everything was correct? Probably never. So this is where
understand what your limits are. If you run into someone understanding, oh my God, what am I going to be out?
I had my basement, my basement flooded. We had a pump problem down in my basement. And the first thing I did is when I called, I had a buddy that does cleanups. I called him and he's like, dude, do you have like basement flood coverage? And I'm like, I don't know. He's like, you better check, because most people don't. And I checked, and thank God I had it. But that's one of those things, didn't know. So that's why I had you on here. I was just like, this information is way too important to pass by. So I think we got
Kat's getting on us. Kat's like, read some of these questions. I guess we have more questions coming in. Let me read it. I'm sorry, Kat. I don't want to cut Dan off. It's his channel.
No. Roll.
Right. What happens if it is sold from one service company to another? Does this affect anything? Okay, so this is a great question. Just be yourself. I love your handle, by the way. Almost 50% of borrowers, no, it's a little less than 50%, but a huge number of you are going to change servicers because the government is not renewing a bunch of servicers' contracts, okay? Like Fed Loan, that used to manage the public service loan program, did not renew their contract. So all those loans moved over to Mohila, okay? So there's gonna be a ton of people changing servicers. Navient's out of the game. There's some others, and they're transferring it to like AidVantage, Ed Financial, different companies, right? technically nothing is supposed to change. I say technically because I know that it's untrue that things don't change. So this is what I recommend to borrowers who have servicer changes. Number one, know that you will have to reestablish your online account with that new servicer. You want to, if you can log into your old servicer account, go on there and screenshot everything, because if there's any prior communication in those secure messages or any of that, you want to have some, just know, right? Because it was maybe from 3 years ago. You might not even remember. Just kind of have some snapshot. If you can't do that for whatever reason, then you can always log into your new servicer account and compare it to what the federal government at studentaid.gov says. Okay. They're technically supposed to take the data from the National Student Loan Database, which is managed by the government, to service your account, but things are imperfect. And so it's always good to check, what was my balance at that old servicer before the pandemic? What is my balance now? And another thing also, like annualcreditreport.com, you get your free credit report annually, right? I also recommend people checking their credit, because when the pandemic initially started, servicers did not accurately report payments to the credit bureau. So like, we were in a pandemic pause and a bunch of people, obviously 40 million plus people, didn't pay their student loans, and a bunch of servicers were just reporting everybody's payments as late. So if you went to take out a mortgage, you probably noticed that and corrected it. But if you never tried to take out a mortgage or anything during this pause, then you don't notice that there's all these issues on your credit report. So that's another thing I recommend people do. Go to annualcreditreport.com, download your credit, and start to look. Did the servicers ding me, right? Go to studentaid.gov, compare it to your new servicer account. Make sure to enroll in auto debit with that new servicer. Make sure your notifications are on. Make sure they have their accurate phone number, email, and address, because if they send out any notices of repayment starting, you're not going to get those, because they have a lot of people change their email and address from the time they graduated, and servicers, unless you log in and tell them, it's not consistently being updated. So it's really important that you update that information and make sure the information is accurate. So I hope that answered your question. Just be yourself.
Yeah, I think we already went through this question. Kat, flick to
Well,
the
okay,
next
yeah,
one,
we went through that
please.
question. Yeah. Oh, okay. So Osman answered, my auto pay states this loan is not an active repayment. Does that mean I should just wait to hear from them? Yeah. So Osman, so this is what's happening. The servicers are literally just going haywire crazy right now. Like, and what that means, it's okay, honey. What the haywire crazy means is they're literally just working really hard to get everybody, like, to understand, okay, what are people's balances? What plan were people in before the pause? What's their payment going to be? All that right now. So until you have a payment, you can't set up the auto debit. So you have to wait to get a payment in order to set up the auto debit, because you can't set up an auto debit when there's no established payment. Does that make sense? So you have to wait until there's an established payment. But Osman, what I would do is once that amount is established, understand, can you afford that payment? And if they don't get that information to you with at least 45 days ahead of when repayment starts, I would call them up and demand to know what that amount is. And the reason I say this is because you don't want to find out 5 days before the payment's due, and then you're like scrambling to file the paperwork to get your payment into an affordable position, right? So I love that you're asking this, because it's clear that you're trying to plan. I tell everybody, because right now, if someone tries to call up their servicers are like scared they're going to be inundated. So they do this call routing thing. If you want to do this, press 1. If you want to do this, press 5. And then when you get to that option, they're like, oh, if you want to do this, press 1 again, press. And then it's actually like impossible to get through to like talk to someone unless you press like 1 or 5 times or some crazy thing. And so it's really important to just get the information as soon as possible, because you don't want to be waiting the 5 days when everyone is flooding them and they just can't pick up all the calls, right? And so their online systems aren't great. And so that's why if you come through us and we estimate your payment, we'll just file the paperwork and set it up, and you don't even have to make a payment. But obviously, knowing if if you want to afford that fully amortized payment and you want to make that payment, then getting it, you have to get that from them, right? And that will allow you to set it up.
You are the coolest cucumber I've ever seen. You got the baby, your little one screaming in the background, and it doesn't even.
Oh my God, you hear that? I'm so sorry. My husband's home, and my husband's trying to take care of him. But
no worries. We'll answer a few more, guys. Catalina, she has a 10-month-old, and I greatly appreciate her coming on today. So we'll try to get through a few more, and then if you got to go, please, I just appreciate your time.
Yeah, no worries. Kat, last question anyways. Oh, hi, Ed. I know Ed.
Hey.
Hi, Ed. Okay, so Ed, I have seen on credit reports that federal student loans not due until 3/24. Is that possible? Let me tell you the instance in which that is possible. The instance in which that is possible is that the person applied for the Fresh Start program because they defaulted, and they're kind of investigating what happened to their defaulted loans. That's one instance where it's possible. Another instance where that is possible is that they've applied for bar defense. Bar defense was passed by Biden that if you went to a for-profit school and they defrauded you and lied about their career outcomes, which by the way, we help people file into, it's not our normal standard filing fee. It's actually a little bit more because it's more extensive. If you can prove, you basically submit some documentation that proves the college lied to you in some way or form, and there's a whole list of schools that are on there's basically 80 something schools they might have added to it that are on this bar defense list that defrauded students when defrauded people, and now they have horrible outcomes, like they didn't get the career or the job or the internship and all these things people promised. So if they're under borrow defense investigation to get their debt forgiven, then they may not have to make any payments until a later time. So those are the scenarios under which you can get extended repayment. Another scenario, and this is a scenario we help people with, is they don't have an income right now. So they come into LoanSense and we file them at a $0 repayment amount. And so they have a year of $0 payments that actually count as payments. So that's another scenario where it doesn't say no payments due, though. It just says a $0 payment is due, but it's still $0, right? So that's also another instance in which people have $0 that they have to pay, but they're still getting credited towards a payment. So the language might be a little different on the credit report, but they still are paying $0. I hope
Awesome.
that helps.
That was perfect. Here, the thing that I just, and we'll conclude it at this. It's hard to believe that all this is taking place with government student loan systems. I mean, it seems like, and don't take it, it seems like it's a complete mess. It's like, I get deja vus of like the mortgage industry like 20, 30 years ago when it was just the Wild West. You charge whatever you want, you do this, you file paperwork if you wanted, whatever. And now it kind of seems like it's the same way. And it's just,
it's the same because here's the thing real quick. Biden created more programs to create more relief. Kat, do you mind putting up that link again so I could just read it out loud? So created more programs, which is adding to more complexity. Kat put up an amazing link. So I can't get the link right now to the payment count letter, but if you sign up for this, we'll get your email and you can always email us. We'll get you the payment count, but Kat put up the link to, we have a report of student loan forgiveness programs broken down by the state. And it's on bit.ly/student loan forgiveness program by state. I know that's super long, but it is exactly as it says. It's bit.ly/student loan forgiveness program by state. And I'm telling you, that is still shorter than the link that our CRM produced. So it's still shorter, bit.ly/student loan forgiveness program by state. Okay.
I use that system every once in a while too, bit.ly, to shrink your code. Your URL, because it's like this big, and then you're like, I just want it this big, and then it doesn't make any sense.
Oh, so. Yeah. And also, like a bunch of the links run out, so we like struggle. Like, what do we make the link? Yeah. But anyways, I just thank you so much, Dan, for having me on. As always, invite anyone to get a free analysis, and our website, myloansense.com. Like the free analysis is linked right there. It's in the description, and also. Yeah, please. I mean, I have a YouTube channel. I obviously do not have as many followers as Dan, but I release content on a weekly, sometimes twice a week basis around student loans. Oh, look. What's that? Subscribe. You can subscribe to Dan if you're not, but also you can subscribe to
I
me
got
if you're.
that for Father's Day. I just hit 25,000 subscribers.
Oh
And
my
so
God, that's a
my
huge
my
deal.
kids got me this for Father's Day. So we're
Oh, that
getting
was
there.
cute.
We're
It was
growing.
backwards. I couldn't read it, but that's
Oh,
cute.
sorry.
No,
So
no, no.
I'll let you run. I know you got a little one in the background. I greatly appreciate you being here. Kat, at the last minute, her husband was running a little bit late. She had to take care of her little one, but you're a world of knowledge, and I can't thank you enough. So and just so you guys know, all the information is going to be down below in the description. We'll put the code so you can save some money there. We'll put the link right to her websites. We'll also put the link that she just put down, the bit.ly, the long version of things, so you can actually so they can send you an email of all the options that you have available to you. So thank you again so much for joining us tonight. Thanks, Catalina, for everything you do with us and for everybody else you help with. So thank you so much. And guys, we can't do this without you guys viewing us. So if you would, please don't forget to give us a thumbs up, subscribe down below, and hit the bell every time we post a video. You get an alert. Take care. God bless, guys. And we'll see you next time. Later.